Welcome to Virtual Office Hours, learning about investment essentials, sponsored by the American Bar Association and Access Lex. The Virtual Office Hours series connects you with experts to help you thrive as a law student and prepare you for life after law school. When it comes to investments, there is a lot to consider, especially while managing the stressors and the workload of law school. Having a good understanding of investment funds and approaches is essential to investing with confidence and planning for life beyond law school. We're excited to have Derek Brainard with us to discuss the basics of investing and to answer your questions. So if you have any questions during this time period, just drop them in the questions, the Q&A component of the dashboard. Derek is a U.S. Navy veteran and Director of Financial Education at Access Lex Center for Education and Financial Capability. He has worked in both the private financial services sector as a licensed financial advisor and in higher education as a financial literacy coordinator at Syracuse University, where he also completed his MBA. His financial writing and commentary has been featured via U.S. News and World Report, MSN Money, NBC News, and USA Today. Derek, we'll turn it over to you right now.
Thank you, Tracy, and thank you all for being here today with me during these office hours. I am looking forward to spending the next hour or so chatting with you about a topic that's near and dear to my heart, and that is investing. And because we're talking about investing, we have to definitely put a little disclaimer out there, right? The information provided in this session is being made available to assist you in developing your personal financial strategy. And it's not intended as investment, tax, or legal advice. You should consider whether it's appropriate for your needs, and where applicable, seek advice from an appropriate professional advisor. And that's part of today's message too. We're going to talk about the essentials of investing. And one of those essentials is knowing when and how to plug into professional financial advice. And so we can obviously be chatting about that as well. We at Access Lex Institute, Tracy mentioned, I'm with the Center for Education and Financial Capability, and we are so excited to partner with the American Bar Association for this series. And if you look on the screen here, you'll see the Max by Access Lex program, which is our personal finance program for law students specifically. And so this might be something that sounds familiar to you, maybe not. Maybe it's the first time you're hearing about Max by Access Lex. But if you're at a Max participating law school, of which there's about 167 in the country, then you'll be familiar with Max. And a lot of the resources that I talk about today are resources that you can learn more about in the Max program. But if not, that's okay too, because we do have resources for folks that are not at Max participating schools to plug in and access. So with that said, I'm going to go right ahead and jump into kind of a primer before we get to questions for the office hours, because we actually had a list of great questions that were pre-submitted that I know that we want to address. So before we do, I think it's always helpful to kind of start to speak the same language when it comes to investing. So I want to kind of give a couple main points before we jump into questions. The first is, what is investing? And I think that this is it's just an important thing. How can we distinguish between saving and investing? And one of the explanations I like most was from famous investor Warren Buffett. They call him the Oracle of Omaha. He knows a thing or two about investing. And the way that he describes investing is the process of laying out money now to receive more money in the future, or a future benefit. So I want you to think about that. Okay. There's many ways to do that, but we're kind of distinguishing it from a savings / money market account. And we're going into more of a focus of long-term wealth accumulation in vehicles that give us a greater chance for success. Because why? Because gains are typically higher when you invest than when you're traditionally saving, because you're participating in the growth of the American economy. When most folks think about investing, they're thinking about things like stocks, right? The S&P 500, which is an index that represents the 500 largest companies publicly traded in America. They think about things like the Dow Jones Industrial Average, which is 30 of those largest companies. And these indexes represent a significant percentage of the total American economy. When you invest, you are literally buying into these companies. You're buying shares of the companies if you're buying stocks, or you're lending your money to the companies if you're buying bonds. So that's why it works. When we can participate in the growth of the American economy, which has grown exponentially over the past several decades, then we're really being able to give ourselves a boost in the long term. And we do that through a process. It's called compound growth. If you just leave your money in there, let it sit, and it grows for a year, and you leave it all invested, then the next year's growth is going to be on that first year's deposit plus the growth. And that's how it kind of snowballs for us. So that's the power of investing long term. And here's the thing. Today, what I want you to take away from this session is one of the things is that investing doesn't have to be complicated. In fact, the more complicated your investment strategy is, the higher the probability that it will not be successful, if that makes any sense. Usually, investing tracks along the principle of Occam's razor, which if you're familiar with Occam's razor, it's usually the simplest solution is the best one to choose. And with investing, there's really no exception to that. So investing is usually done by most workers by using mutual funds inside their work-sponsored 401k, or through an individual retirement account, which is also known as an IRA. A 401k is just a type of account that you have available through your work. Your employer offers it to you, and that's for the private sector positions, a 401k. For public sector positions, you might see it might be a 403b, which is kind of like the public version of the 401k, but it performs the same function. It gives you an account to stash money for retirement. Inside the account, you're going to be able to invest in things like mutual funds, sometimes index funds, and also target date funds. And it gives you, lets you do that in a tax advantaged way. So these are really powerful retirement investing vehicles. But the IRA and the 401k themselves are not investments. They're just types of accounts that you can use to invest inside. And inside you pick which funds you want to invest in. The most commonly held investment in the country is a mutual fund. Okay, so what is a mutual fund? So many people own a mutual fund and they don't know what it is, or they can't really explain what it is, right? And so if you own something and you're going to be investing in it over the course of 20 to 40 to 50 years, you probably want to know kind of how it works. Not to say that you need to really get in and know how everything under the hood works with a mutual fund. You can if you want to, and there's resources out there for you to do that. But generally speaking, a mutual fund is an investment that allows you to pool your money with other investors to purchase a collection of stocks or bonds, okay, that would be difficult and or just too expensive to recreate on your own. So what do I mean by this? Okay, so we talked about the S&P 500, and inside that index is 500 companies. And you say, well, geez, I just want to do what that index does. I want my portfolio, my investment collection to do what that index does. Well, if you tried to go out by yourself and buy one share of all 500 companies, it would be exorbitantly expensive because you're going to be paying commissions on all of those purchases of each stock, and then plus the share prices themselves. Some of these company shares are in the thousands of dollars for one share. So instead, mutual funds let you take that money that you're going to want to invest and pool it together with a bunch of other investors. And I have a visual here, which is just more helpful, I think, than words. Here we go. So on one side of this, you have you and me and a bunch of mutual fund shareholders. Okay. You have the mutual fund itself, which is just a company. And this company is going to take our money. Okay. You can buy shares of this one company. You buy a share with your money. You're putting your money into this pot of money with thousands of other investors. This company then goes out and hires mutual fund managers, and they take our large pool of money that we've mutually funded, and they buy a whole bunch. They buy all the stocks in the S&P 500, or they buy a collection of investments based on the goal of the fund. The goal can be to aggressively grow your money. It can be to protect your money. It can be to have a little bit of both growth and income. It can be to invest in international stocks only. It can be to invest in a certain sector of the economy. mutual funds can be split and spliced any which way, depending on your objective. So that's how the funds kind of flow in a mutual fund. But as I said earlier, there are many kinds of like flavors of mutual fund, right? So mutual funds are some of the most commonly used investments inside a 401k, because inside your entire retirement account of work, you're going to have 20 to 30 options of what types of investments to use. Most of those will be mutual funds of different kinds, like I just mentioned. You'll also have potentially index funds, and I'll circle that over here, index funds. And index funds, they don't necessarily have one of those managers who's in charge of going out and buying and selling stuff within there. Instead, they're going to do things like just track an index like the S&P 500 and let it ride. So the costs on those funds are a lot lower, because when you have a mutual fund that's paying a manager to do that work, it's kind of like the manager's acting like a lifeguard for that fund. Then those folks have to get paid, right? So actively managed mutual funds can cost a little bit more, sometimes a lot more, than a passively managed index fund. That's why index funds are so wildly popular, by the way, because they're very low cost, they're cheap, and they do things like just track the market. Statistically speaking, the market, the S&P 500, if you want to measure the market that way, has outperformed the majority of these managers who are trying to beat it, okay? So most of the time, the majority of the time, actively managed funds underperform the actual market as measured by things like the S&P 500. There are funds out there that beat it. It's just that you have to work with somebody or know kind of what you're looking for to find those funds. And then target date funds are the other common vehicle that are growing in popularity that you need to know about as a beginning investor. Target date funds, these are funds that will be named after the year that you think you're going to retire. The target date is the year that you think you're going to retire. So say that you are 25 right now and you want to retire at 65, for easy math, that's 40 years. So you would buy a target date fund 2060. And the funds are going to be named based on the company that's selling them. So if it's like a Fidelity Freedom Fund to 2060, or there's Vanguard Target Date Funds 2060, but there's also, American funds and also some of those other big mutual fund companies. A lot of companies have these target date funds because they're very popular. So what those funds do is they take a lot of the work out of investing for you. A target date fund will start with a certain percentage of stocks, okay? So let's just say if you're young, it might start out with 80 to 90% stocks, okay? And it might start, and it'll put the rest of that in that fund will have 10% in bonds. Stocks are considered to be riskier than bonds. Bonds are considered to be kind of like kind of like an airbag of a portfolio. If the stock market goes down, then much of the time bond values can go up. So they have this kind of inverse direction. So they say that, hey, if you have a long time to own stocks in your portfolio, then you can start out with a higher stock allocation. Great. But as you get closer to retirement in the year 2060, a target date fund will automatically rebalance your allocation. It'll turn up the bonds and it will turn down the stocks, okay? And then you end up with kind of a flip scenario. Now, it probably is not going to be as extreme as 10% stocks, 90% bonds. That's very extreme, because in retirement, you still need to have your money grow, right? You don't want it to just stop growing because you need it to last presumably another 30, 40 years. So target date funds are about as close to a set it and forget it type of investment as you can have in your retirement account. And that's the big takeaway. If all you wanted to do was just start investing and have it be as simple as humanly possible, then really you're talking about 3 steps, okay? 3 steps. You open your 401k account at work or 403b, right? That's step 1. Step 2 is you pick a fund to buy whenever you set your whenever your money comes over from your paycheck. You set up automatic contributions to this 401k account, and then whenever the money comes in, you pick a fund to buy, and then you just increase your contributions over time with pay raises. And if you do that, that's about as simple as it gets in investing, folks. If all you ever did was that, if you start working and you have access to a 401k account, and you open it and you say, okay, every paycheck, I want to have 5%, 10%, 15%, whatever you want, going over to this 401k. When it gets in there, I want it to buy this fund, whether it's a target date fund or an index fund or a mutual fund to start. You can just start with one of these funds and build up your position over time. Then that's going to be just getting money in there as quickly as possible is the most important thing. Okay. And then increasing contributions. If you get pay raises each year, hey, throw more money in there and you'll be in good shape as you get closer to retirement. That's the easy answer. It's sometimes difficult to do, right? It's a simple answer, but it's difficult to do behaviorally because we have so many competing priorities with our money. Do we pay off our debt quick? Do we, save up for a house? Do we invest for our kids' college? Things like that, right? So in general, what I just wanted to leave you with before we go to some questions here is the essentials of investing really kind of in four categories here. Is just have a plan. If you can be a goal-driven investor, then you're gonna be much better off than if you didn't have a goal. And maybe that's just retirement. If you want help setting a goal long-term, then I would encourage you to use things like our Access Connects financial counseling program, which is a free financial counseling program available to any law student, not just Max law students. So I'm going to put that in the chat panel for us all here. There's a link to that service. That's a financial counseling service. Again, you can use it's a phone. You set a phone appointment with one of my team of accredited financial counselors, and we're happy to talk to you about these concepts in greater depth. The other thing that you want to, if you're in Max, if you have a Max personal finance account, you can access a similar service through Max Coaching, which is that second link that I put there. Okay. So have a plan, set a goal. That's going to be your first step. Number two, manage risk. And again, this comes down to you can take online risk tolerance questionnaires with any online broker. If you go to Vanguard, Fidelity, Charles Schwab, any online investment service is going to have a risk tolerance questionnaire that you can fill out, usually for free, that you can understand. Do you have a high risk tolerance or a low risk tolerance? Are you an aggressive investor or a conservative investor? And that's going to help you understand. If you have a high risk tolerance, it means, you know what, coronavirus, I sent those links to all panelists instead of attendees. Here you go. Sorry about that. There's one, that's the Max Coaching link. And then here's the Access Connects link for any law student here. Just getting here. Up here. Here we are. There, okay. Sorry about that, there you go. So high risk tolerance, listen, if something like the coronavirus in March caused the markets to plummet 30 to 50%, depending on the index you were looking at. If you were the type of person that you had investments and you said, okay, it is what it is, I'm gonna ride it out. In fact, I might even try to invest more now that it's really low, then you have probably a pretty high risk tolerance. It didn't make you queasy. And especially if you have a long time horizon where you don't need the money for a long time, then you could consider yourself having a high risk tolerance. A low risk tolerance would be a response where you had a response like, oh geez, I need to sell everything that I have now, get out, because I'm scared of what's going on. And so that would be a low risk tolerance. And there is no right or wrong risk tolerance. You just need to know your own risk tolerance. So should I have a lot of stocks in my portfolio versus bonds, or should I have a nice mix, maybe 70-30 or 60-40 to start? And that's where risk tolerance comes into play. Again, the easy way to do that is through mutual funds, because you can own a balanced mutual fund that has 60% stocks, 40% bonds, or 70-30. You don't have to go out and hand pick these stocks and bonds by yourself. That's the power of mutual funds. We talked about cost a little bit. You want to just be cost conscious. Costs for investing vary depending on the type of investment you're talking about. There's a charge to buy a single stock, just the transaction cost. For a mutual fund, the same thing might be something called a load, okay? There are certain funds that are no load, and those tend to be like the index funds and ETFs. ETFs are exchange traded funds that are like index funds that just trade on the open market, like the New York Stock Exchange and things like that. And then there are annual fees, right? The annual recurring fees on funds are called the expense ratio. And so the higher the expense ratio, the less your net return is going to be compared to a similarly performing fund with a lower expense ratio. And you're going to say, well, what is the expense ratio? It's the money that they take out of the fund's account to pay for things like marketing and distribution of the fund and their managers. So the higher expense ratio per year, the less you get to keep in your pocket versus the lower. And then finally, stay the course. Like I said, it's a long-term game investing. It's not gambling. It's not speculation here. We're talking about your serious long-term money that's we're going to put into a tax-advantaged or tax-sheltered account for retirement, or a brokerage account if you're investing for something that's 10 years or more away. Stay the course. It's going to be, sometimes it's hard to do when things get rough, but just know that there's a reason that the old adage, buy low, sell high, is a thing. It's because most folks do the opposite. Okay. It is hard to do. It's easy to say, it's hard to do. So just stay the course, and that's what will pay off the most in the end. So with that kind of primer, I know that's like a lot of information crammed into a 15-minute introduction there. And that's all I wanted to give you to start. And now what I want to do is, we had so many great questions. I want to leave plenty of time. So Tracy, if we can start to address some of those questions, I think we'll be able to unpack investing a little bit more that way too.
No, great. We did receive a lot of great questions during registration. And,
Yep.
The law students, want to know how to start investing, especially, when you're a beginner, you might have limited funds, living hand to mouth, trying to pay for law school.
Yeah, that's a great question. And so I'm going to actually share, just go ahead and share a whiteboard with y'all so I can take some notes as I talk and kind of capture some of these thoughts. And so how do you start? I think that's the most basic question, and it's a good one. So let me just get this here and whiteboard. Okay. Maybe it won't let me write on it, which is okay. All right, it only wants me to write on it with a pen, so I'm not going to do that. I'd rather type. So what I will do is here's what I'll say. Okay, it's working now. Wonderful. Okay, so when you're starting out, here's kind of my mantra that I talk to a lot of students about with regard to order of priorities. How do you get started as a full-time student? I think the first step is to learn. The second step is to earn. And the third step is to invest. Like so many times, we want to start with the third step, which is, how do we start investing now? And the problem with that is that there's opportunity cost. If you start to take money now and start putting it into investments while you're a full-time student, you might be skipping over some things that that you don't want to be skipping over. For example, student loans, right? So student loans, if you're borrowing for law school and you're borrowing somewhere in the realm of 4 to 6% interest, okay? So the money that you'll be using to invest is that money that you're going to be turning around and borrowing the same amount from a student loan refund. Well, that's an opportunity cost that you need to consider, because you're going to pay upwards of 6% on your student loans over 10 years, right? And so let's just say that you had, and this is just for sake of easy numbers, right? This is the reason for my learn, earn, invest framework I'm giving you all, just a little bit of a business case here. Say that you had $10,000 and you wanted to start investing. And so you invested that in the markets, okay? Well, that could get you an average of, who knows, it's 7% over 10 years. And if you got that, it might grow to somewhere between $18,000 to $19,000, right? In 10 years. And that's not a guarantee. It's just, if you look at the historical returns in the stock market of 40 to 50 years, you're looking somewhere a little bit shy of 10% average return. Some years higher, some years much lower. But if you take out inflation of 3%, the real return's around 7%. So that's why I use that projection. So if you invested that $10,000 as a student and gave yourself 10 years, then it might grow to $19,000, which is pretty sweet. But if that was money that you also borrowed, so if that was money you could have put towards your student loans, but you didn't and you borrowed, then you have your $10,000 student loans at 6%. And that means over the 10 years that it takes you to pay that back, you're paying somewhere around $3,500 in interest. So it's a question of, what do you think you can get in the market versus what do you know you will pay in interest on your debt, on your student loan debt or your credit cards. So that's the first thing, is we want to be thinking about that while we're current students. That's why our first objective is to learn and get through school with the least amount of debt as possible. So learning is kind of like two pieces as you're starting as a full-time student. And number one, what I'm talking about here is to learn about investing. This is the perfect time to do it in a lower stakes environment. And the second piece of this is to borrow as little as possible for your education, right? In student loans for law school, obviously a reality, right? Most students are borrowing for law school because of the exorbitant price tag, but getting, that $1,000 here, $500 there, $3,000 there, this stuff adds up in terms of borrowing and interest that you pay over the life of the loan. So that's one way that you can actually make a quote unquote investment now, is to borrow less. If you can use that money you would have otherwise invested and pay it towards your tuition and fees instead of borrowing it, then that's a guaranteed return of whatever you're going to pay on the interest. So I think of that as an investment. It's the same thing as if you're going out and you're grocery shopping and you can go to a bulk store like Costco or BJ's or one of these stores, and you can get a deal on some food for 30 to 40% off if you buy it in bulk. You can't get 30 or 40% on the same amount of money in the stock market. So those types of decisions that are in the consumer borrowing space or consumer spending space are just as important as starting to invest while you're a full-time student. So even if you're living, paycheck to paycheck or student loan refund to student loan refund, number one thing that you want to do is, do you know what you're doing with the investing, and are your student loans in a good place? It's not to say that you can't invest while you're a student, but you want to make sure that you understand that opportunity cost that's at play there. And listen, you might say, great, I think I can make 7%, 9% in the market. I'm comfortable carrying 6% interest on my student loan debt, so I'm going to invest in that. And all I'm saying is, at least you made that informed decision, right? So that's the first piece. The second piece is to earn, obviously, right? So cash flow is a big deal with investing. You got to cover your basic expenses before you can use your discretionary income to invest. So securing an income is a big deal. You might be a non-traditional student that works full-time during the day and goes to law school at night. And so you have an income. And so you're in a position that you can do this. Or maybe you work over the summer at a paid summer experience and you're making some great money. Maybe you're working at a big law firm over the summer and you're making several $1,000s, tens of thousands of dollars. And you're putting a piece of it towards your student loans because you're like, okay, I remember what he said about that opportunity cost, so I'm going to pay down some of those, but I'm also going to invest some of this money. Then we have that cash flow to use. But if you can't cover that, cover the four basics, which is what the food, shelter, transportation, and clothing, but I also throw in like insurance premiums, like healthcare in there, utilities. These are the basics. If you can't cover those and you're thinking about investing, you're probably thinking out of order. So getting that income secured is a big deal, just to make sure that you have your cash flow in place to start investing. And just because you have your cash flow in place doesn't mean that you can start right away. Sometimes, if you don't have access to a 401k, and you need to invest in something like an IRA, like an individual retirement account, once your income starts, if you open up that individual retirement account in something like an online broker, like Vanguard or Fidelity or Charles Schwab, those are the big three I always mention. And by the way, I'm not recommending either one over the other, but those are just very commonly used ones. If you open it, sometimes if you're looking at index funds in there, they'll have a minimum amount to start investing in those funds. Okay. And that can be, $1,000 to $2,500 to $3,000. So sometimes when you start earning, the name of the game is just saving for the minimum buy-in. Okay. So that's the other deal there for step 2. And then finally, the third piece is invest, right? Just do it. And so, yeah, we've learned about it. We have cash flow that we can use to invest. We have all of our other bases covered. And so then you can just start investing. Now, as a student, if you're still a full-time student and you're not working for an employer that has a 401k, and you don't really have a lot of earned income to speak of, and you don't want to be investing for retirement, you kind of want to just start investing, just to start, just to kind of learn about it. And maybe you want to use that money down the road a ways, maybe 10 years down the road to buy a house or something. Maybe this is non-retirement money, and you have a time horizon of 10 years or more. Okay, I use that number deliberately because if you look at the history of the stock market, the market, goes up and down and up and down and up and down. If you look at the history, though, any 5-year rolling period is going to be pretty volatile. It means that if you put money into the market and try to get it out in 5 years or less, then the chance of your account balance being lower because of the market movement is a higher probability than if you had left it in there for 10 years or 15 years or 20 years or more. So your time horizon is important. If you can leave it alone for 10 years and before you need to use that money, then but you don't want it for retirement, then you can start out just using a regular old brokerage account. And these are both single and joint. So if it's just you investing, then you can use a single brokerage account. If it's you and a spouse investing, for example, you can use a joint account. And those are just straight ahead. You open the account under your social security number, and you transfer money from your bank account to that account electronically. And once your money goes over into that account, once your cash is in that account, you pick your investment that you want to put in, whether it's a total stock market index fund or something like that to start, just to get your feet wet in investing. Then that's a very simple way to do it. Remember, that's not a tax advantaged account like an IRA or a 401k, but it is a way to start that you can access the money without penalty, unlike those other retirement accounts, where if you try to get the money out before the age 59 and a half, then you have to pay a penalty on what you're trying to take out. So there's nuances to that, but there's just a couple options. So as a current student, what's the bottom line? Number one, you're in a great spot right now just to learn. If you want to dabble using some of those things I talked about with a brokerage account in a broad-based or total stock market or S&P 500 index fund, because it's very low cost, so it's low stakes is what I'm trying to get at. And you're using money that you don't really need for 5 to 10 years, then that's a way that you can start while you're a full-time student. But once you get working and have that earning turned on and have access to your 401k and 403b and want to start pumping in higher amounts or higher percentages every paycheck, then that's going to probably end up being your serious full-time retirement account.
Great. You just were talking about percentages of savings. We do have a question here about what percentage of our savings or discretionary income should we invest? Do you have a specific amount?
Yeah, it's a great question. Everyone loves to have very neat and tidy answers to these things. And unfortunately, for millions of people who read financial books and listen to financial gurus, they usually get it. My answer, as somebody who's worked across the desk with thousands of people trying to plan for retirement, is it really depends. But any amount is better than none amount, especially the younger you are. So here's where I'll start with this. Let me just clear that. And one thing we haven't talked about yet that is extremely important when it comes to how much is, say that you've learned about investing and now you're in the earning phase in step 2 there, and you want to start the number 3 invest phase. Well, the first stop, right? The first stop is usually your 401k and through work. And then with that, they have something, many employers do something called an employer matching contribution. And when you look at that, you can ask HR when you start working how much that is. And what that is they will match your contributions to your 401k, okay, up to a certain percentage of your salary. So that's a pretty sweet deal. And so as an example, they can say, okay, well, we'll match you 5%. If you put in 5% of your pay, we'll throw in 5% of your pay into your 401k. That's amazing, right? Because what is that? That is a 100% return on that money that you just cannot you can't guarantee that in the stock market. Not only that, you would look at a employer matching contribution. You would look at that as a raise that you unlock by investing yourself, right? So where do you start? At least with the matching contribution at work. If your employer offers a match, whether it be 3%, 5%, some employers are more generous, then that's a great place to at least make sure you're hitting that minimum to max the match to start. And maybe you look at that and that's all you can do. You look at your budget and you say, okay, you know what, I want to do that, but I also want to pay off my student loans aggressively. So you're juggling these priorities. If you can at least get the match at work, that's free money that you're not leaving on the table. So that honestly drives more of these starting percentages than any other kind of common wisdom that you hear out there. The common kind of guidance that you hear out there in the financial blogosphere and through financial gurus is 10 to 15%. Like if you can, and so that's well and good. And listen, you probably will have to invest more than the match just to have a financially comfortable retirement. But that specific number, there's actual calculations that you can use to get to it. So you want to work with a financial planner when you're working full-time to actually get the specific amount that you need to invest to hit a certain goal. Or you can, more than happy if you want to set up a max coaching call with me using the link I put there earlier, or Access Connects, then I'm more than happy to run some of those calculations for you. And they're called time value of money calculations. And I just use a financial calculator. And all we do is we just say, okay, so if you were to invest X dollars per month at a certain percentage return over time, over Y number of years, okay, then how much will you have? That's the formula for how do you run these calculations. That's a time value money calculation. And by the way, if you want, there is a cool, very simple, I put this link out all the time for folks because I find it just to be a very simple, intuitive tool to use. If you go to, pulling up right now, if you go to, let's see here we go, investor.gov through the SEC, and you go to there, I put it in the chat panel. This is their compound interest calculator. This runs this for you. You can plug numbers in and this will tell you. Now, if you want to try to hit a certain goal for retirement, then you would just toggle on that link down to the savings goal calculator and you can go from there. So in other words, you can say my savings goal is 200,000 is, well, actually, let me see here if I can stop this and share this. Here we go, perfect. Gotta love technology, right? When it works, okay. So savings goal, so I'm on the savings goal calculator in investor.gov. This runs those calculations for you. So say that you had an actual savings goal for retirement of $2 million, okay? And you're like, geez, that's a lot of money. Well, if $1 million today is, if you inflate it over the next 30 years, you're gonna need 2 million, right? It's gonna double, okay, with inflation over about the next 30 years. So by the time we get to retirement, it's gonna be a lot more than you need to buy the same amount of stuff today that you can buy with $1 million. Not to discourage anybody, but that's just the math, right? So initial investment, say that you have $1,000, okay, and then years to grow, we're going to put 40 years, and then the estimated interest rate, like I said, I like to use 7% because of the reasons I told you earlier, and the compounding frequency, the times per year that interest will be compounded. With investing, this is a tricky one for folks to understand. With a savings account that pays you a certain percentage of interest per year, you would put annually because it only pays it for you once a year. If it's monthly, you put monthly. But for example, say that there's a 12% savings account out there, there's not, okay? Spoiler alert, there's not. But if there was a 12% savings account out there and it compounded monthly, well, then you want to get 12% per month, right? You would get 1%. You get the 12% divided by 12 months. So that's how that works. That's a savings account that has a set interest rate. Investing, you don't have a guaranteed interest rate. It fluctuates. It goes up and down, right? Sometimes like crazy. So with investing, we put daily as the compounding frequency because it's not even actually, it's more frequent than that. It's a continuous compounding. You just don't often get that with these calculators. So anyway, all that to say, if you enter that in this calculator, it's going to tell you need to invest 740, let's call it $750 every month for the next 40 years. You get $2 million if you make 7% return. If you make, here you say, oh, it's just saying, yeah. So slight adjustments in the variables can affect the outcome. That's for sure. Okay. And that's how that works. So it'll tell you kind of how much you need to do based on a specific goal. But to start, most people are just looking at the matching contribution and making sure they're hitting at least that. And then if they're trying to clear student loan debt or pay off credit card debt, as they're able to do that, then they turn back to their 401k or IRA and they increase those contributions.
Great, thank you. We have another question here. What are margin accounts and how are they best used?
Margin accounts. Wow, we just jumped from beginner investing all the way to kind of advanced investing. So with that, let me just go back here. Okay, so margin accounts. Okay, so remember we talked about brokerage accounts, and I think I saw a follow-up question too about brokerage accounts in the chat panel for broker. Are those on Vanguard too? How do we choose which investments to make? Yeah, so brokerage accounts are on Vanguard, Charles Schwab, Fidelity, and at full service brokerage accounts like Edward Jones, Morgan Stanley, any of those types of places, you can open just a regular brokerage investing account. Margin accounts are going to be kind of more of that full service brokerage option, where if you go to a place like Edward Jones and open a margin account, or one of the full service brokerage firms and open a margin account, in a regular brokerage account, you are moving money from your checking account into that account periodically, and you're buying a fund. And you can choose which fund to buy by doing a little bit of research on the website, or if you want to start simply, like I said, you can go into a total stock market index fund just to start. And that's going to get you exposure to all of the stocks that are traded publicly in the country. A total stock market index fund is a really common place for a lot of folks to start, just because of its simplicity and the fact that you're spreading yourself out, your risk out so greatly using something like that. So that's an idea. With a margin account is when you literally borrow money to invest from the firm, and they put the money in your account. You have to maintain a minimum amount of money in the account. And remember, you have to pay them back, right, eventually. And so the idea here with margin is you're borrowing the money to invest, and your hope is obviously that the stock grows in value, and then you sell the stock, you pay back the firm what they lent to you, and you have a profit. And in that way, you're using something called leverage. Listen, most people do not have margin accounts because they're higher risk. You really have to know what you're doing, because if you borrow money and what you buy goes down in value, now you still have to pay it back. So you have this sort of risk exposure with a margin strategy that's not, it's just not common with most investors. If you really like doing your homework and staying on top of it, and you almost like the gamification of it, margin can be useful from a mathematics standpoint, but you really have to be hands-on and know what you're doing, or have the help of a professional advisor to make it work. So for the most part, margin accounts are not used by regular investors. It's more of that straight ahead strategy through a 401k.
Great. You talked a little bit about paying off debt before investing and things like that, but do you have any additional tips for building financial discipline?
Yeah. That's a good one. That's what we spend most of our time talking about, is how to build financial discipline, right? Yeah. So it starts with this. Like there's a book by James Clear called Atomic Habits. If you haven't read it, it's an easy read. It's not long, and it's not complicated or anything. But what he says is, I think it's a quote that's a spin off of a Greek poet, believe it or not. And the quote was something like, "We don't rise to the level of our goals. We fall to the level of our systems." That's the quote. And I love this. And it's so true with financial discipline. Really, it is. First of all, you have to make a goal, right? And I like to make sure that we're making a goal in all of the major financial categories, whether it is earning. You want to make earning goals. Like, do you have job advancement opportunities, or do you want to make a certain amount of money? Do you need a side hustle to do that? Earning goals, big time. Spending goals. Maybe you have a trip that you want to do in 2 years, so you need to save up $10,000. Really nice trip. Um, Earning, spending, protecting goal, right? So maybe it's an emergency fund that you're trying to save, and you want to have 6 months cost of living expenses in that fund to cover yourself for short-term unemployment or any sort of emergency in the short term. That's a protecting goal. Then you have your, borrowing goals. Maybe your goal is to increase your credit profile, or maybe it's to pay off student loan debt. And then finally, your investing goals, right? So you want to make a goal, but making the goal by itself is not enough to drive discipline. What you need to do after you make the goal is figure out the habits that support the goal, right? And that's where financial discipline comes in. You cannot just one day wake up and say, I need $3,000 in my savings account. What you need to do is you need to say, I need $3,000. That's my destination. But now I need to map out the specific daily thing I need to do to get there, or monthly thing. And usually that's like an automatic contribution from your checking account to a set aside savings account for an emergency fund. For me, I like to put our emergency fund in a money market fund at our brokerage firm. So it's not even at my bank, because I know that if it's at my bank, I'll be more tempted to move it from my savings account to my checking account. So that's part of my system for my emergency fund, is every month we move over our set amount that we want to save into our emergency fund at our brokerage firm in a money market account. And that's the system for that. With paying off debt, I mean, you can follow any debt repayment plan. Very popular plan out there is the Dave Ramsey debt snowball. I talk to people all the time. They love that plan, and it's a great plan for getting out of debt. Specifically, you line up the debt smallest to largest, you pay the minimums on all of them, and then you pay as much as you can on the smallest debt, and you roll it over, and it snowballs. That's a system, folks, and that's how you build financial discipline. It's not just making the goals. You have to build in that daily habit that supports getting you there. So it's hard at first, but then the more and longer that you do it, the easier it becomes. It becomes like second nature. I think there's a couple tips to, like, make it obvious, make it easy to do, make it rewarding. So like if, for example, your goal was to lose weight, and that if there's chips in the cupboard, I'm going to eat the chips. Well, you need to make it obvious or make it easy to stay in your plan by getting rid of the chips. Like there's things that you can do to help build that discipline, but it's that small stuff. It's the small daily stuff that really helps us chip away at those goals. And then I see a question here in the Q&A. What's your opinion of apps like, for first-time investors? Listen, I think they're fine. Most of the apps that you see out there are going to be things like Robinhood or Betterment or Acorn, stuff like that, and they're fine. I don't specifically know anybody that uses apps for their entire nest egg, just because of their novelty. They're still a little bit nascent. They're a little bit new. That doesn't mean that they don't have good support services. Some of them do, but there's just a lot of unknown about them versus the traditional systems like 401ks and IRAs through brokerage firms. But I think that they are convenient in the learn phase. Remember, my first phase was learn, and the second was earn, and the third was invest. I think apps are very convenient in the learn phase. And if you want to keep your investment account in the app, even when you get into the earn and the invest phase, then that's great. And I think they're probably more useful for short to midterm investing goals, like buying a house or trying to start a business in 15 years. And you have that at your fingertips. Within apps, a lot of those apps, what you'll see commonly used are ETFs. Those are exchange traded funds. And so your universe of investments might be a little bit more select than if you were in an IRA or a regular brokerage account. And that's not necessarily a bad thing, because with ETFs, you still have options like total stock market exchange traded funds or S&P 500 funds. So you still have those same types of vehicles. So I'm not against them. It's just not something that I've seen used for serious long-term investing the majority of the time. There's a handful of folks that swear by them and use them. I don't think that they're a bad idea, but what I would say is you want to look at, do they offer support services for when I'm getting more and more money into this account and need help? Number one. Number two, what are the costs associated with carrying the app and conducting transactions on the app? And number three, what are my selection of investments on the app compared to a more traditional investment vehicle? And those are the three questions. And if you're happy and comfortable with the answer to those three questions, I don't think there's anything wrong with them.
So Derek, there's another question about where's the best places to go learn more about what stocks and investments that you should be made?
Yeah. So that is a great question. How do we learn about what stocks and funds to buy? Well, you can definitely set up a coaching call and we can talk through the specifics of that, or you can go to any sort of resource. Now, if you are at let me clear this right here. Okay. If you are at a max participating law school, then you can definitely go to your account there, accesslex.org/maxonline, and you log in. We have lessons on stocks and bonds, and we have a Foundations of Investing guide, and I teach a series through there. If you're at a non-max participating law school, again, it doesn't mean you don't have access to resources. Then you can just use the Access Connects, but also everyone can use things like investor.gov. They have great guides for free on mutual funds, saving and investing. The other place I love to go, and honestly, the two sites I use for financial research most are, and I've been doing this for a long time, right? Yahoo Finance and Morningstar. If you go to Yahoo Finance and type in a stock ticker, you can check out whatever company you'd like and see what they're doing that day. And again, if you set up a call with me, we can walk through a couple examples so I can tell you, hey, here's something to look at. Here's the current price per share. Here's their price to earnings ratio. Maybe here's their dividend yield. There's a couple key indicators there that we can talk about on a more technical level if you're really interested in stock analysis. And in Morningstar, if you type in any sort of stock company or name of a mutual fund or index fund, it's going to give you a nice sheet on how they rate that fund, what's inside the mutual fund, how expensive it is. And so those are some of the top resources there that you can start to just kind of poke around and start to learn about this stuff. Is the investor.gov, Yahoo Finance, Morningstar. I also think that Google Finance is pretty good, and it's kind of more user-friendly and intuitive than Yahoo Finance on some levels. And so those are some good ideas.
Great. Along the lines of, doing some research and predictions, we have someone here asking about the value of inflation hedge assets, specifically Bitcoin and gold, performing over the next year.
Oh, wow. Yeah. So we're going again, it's fun. We're bouncing from like beginner or a fundamental investing to a little more advanced, and that's great. So you said Bitcoin and gold. Okay. So interesting. So yeah, so Bitcoin and gold, listen, they're like this. Okay. That's the best thing I can do on the whiteboard. They're very volatile. Okay. People think of them as an inflation hedge. So what does that mean? It means, like I said before, if inflation was 3%, then Bitcoin and gold can be a way to kind of steadily make that at least. But that's not the case in the short term. Bitcoin and gold, on the very contrary, are very widely volatile. It means they go up, they swing in value based on what's going on in the market. So they're not really an inflation hedge in the short to midterm. So don't make that mistake. In the long term, maybe gold's a little bit, it's just more well known, right? Bitcoin is less known and less proven than gold. Listen, you can buy gold in an ETF, which is a fund that will help you invest in gold without having to buy the actual bullion itself, which is less liquid. Like you can't just go and buy and sell gold like you can the shares of an ETF. Okay. Bitcoin, I've heard that some rumblings about crypto ETFs that where you might be able to invest in cryptocurrency without having to own it. Because again, the problem with owning cryptocurrency is it's not accepted everywhere if you want to use it, and it's a little less liquid. You have to go open up a coin account. You have to buy the coin. You have to keep it in a digital wallet. It's not going to be mixed in with the rest of your investment portfolio. So if it's for investment purposes, you just really want to know. So standard idea here is with gold and cryptocurrency, if you want to try it out, but don't be putting all your money in it because it is so wildly volatile and is so unproven. And we know that if you want an inflation hedge, the S&P 500 over time is an inflation hedge. Real estate over time is an inflation hedge. And these are, while they're volatile, they're not as widely swinging as something as Bitcoin. So anyway, that's a 2 cents on those.
Great. If you have any additional questions, drop them in the chat right now because we're going to be wrapping up shortly. Or you can also contact Derek after the program. We'll provide his information in a follow-up email. So if we don't have any more questions, I think we're going to wrap up. So thank you for joining us today, and a special thank you to Derek Brainard and Access Lex. We hope you join us for upcoming virtual office hours programming. You can visit abaforlawstudents.com for the full lineup. We also encourage you to check out ambar.org/debt for the 2020 Student Loan Debt Survey Report, which examines the issues at the heart of the student loan crisis and offers some recommendations. So thanks again for joining us. And Derek, thank you really for sharing your expertise with everyone. We really do appreciate it.
Thanks, Tracy, and thank you, everybody. Have a great day.
Okay, bye-bye.